Hello, my dear students. Let's add value to your knowledge account today. I'm Dr. Bharati Sunil. Welcome to our Finance and Accounting Academy channel. Today's topic is turnover or activity ratios. We are doing ratio analysis series. In that series, now we are in fifth video, fifth topic, that is turnover ratios. Turnover ratios or activity ratios means, so activity ratio helps us to measure, to know how efficiently or effectively managing its resources or assets. We are covering 6 ratios under this turnover or activity ratios. The first one is stock turnover ratio, second one is debtors turnover ratio, third one is creditors turnover ratio, working capital turnover ratio, fixed assets turnover ratio, total assets turnover ratio. First, I will explain all these formulas in detail. Then we'll use these formulas and do one problem. So first we'll come to stock turnover ratio. So why you do this stock turnover ratio? So stock turnover ratio will tell us how many times we have to fill our stock. Say for example, if you take one car dealer showroom, in that car dealer, whenever you go to the showroom, you will find around 30 cars in that showroom, right? So means whether the company is selling only 30 cars in 1 year? No. So when you have checked with the car dealer showroom, you have understood that they are selling around 200 cars in 1 year. So but when you see the stock of cars, you are seeing only 30 cars at once. So what is this? Means they are keeping stock of 30 cars and they are filling the stock whenever they are making car sales. So how they will come to know how much of stock they have to keep? Stock turnover ratio indicates that number of times the stock has turnover into sales. So if you observe in the car showroom, they are selling around 200 cars in 1 year, but how much of stock they are maintaining? They are maintaining 30 cars in showroom. So this you can understand perfectly when you see the formula and its application. So stock turnover ratio, it is also called inventory turnover ratio. In short form, what you will say, ITR or STR. ITR means inventory turnover ratio, STR means stock turnover ratio. Stock turnover ratio is equal to cost of goods sold divided by average stock or closing stock. So how you'll get cost of goods sold? Cost of goods sold is equal to what? Sales minus gross profit. If you deduct gross profit from sales, you will get COGS. What is average stock? Average stock means what? Opening stock plus closing stock divided by 2. So if in problem, if opening stock and closing stock are given, then what you should do, you add both these stocks and divide that with 2, you will get what? Average stock. Say in your problem, if you are unable to get the data relating to average stock, then what you can do, you can take closing stock. If cost of goods sold is also not available, then what you can take? You can take here sales. Is it clear? So based on the available data in our problem, we can use our formula. If you apply this formula, then what you will get? You will get stock turnover ratio. STR means how many times you have to fill your stock, means replace your stock. So next there is one more formula in this stock turnover ratio, that is called what? Stock conversion period. Here you want to know in how many days you have to refill that stock. So how you will come to know? Say for example, stock turnover ratio is 6 times. How you will calculate conversion period here? Stock conversion period is equal to what? Number of effective days in 1 year. So here you will take 360 days divided by, what is our STR? 6 times. So 360 divided by 6 means for every 60 days you have to refill your stock. Like that we can calculate by using stock turnover ratio. So with this formula, what you can understand, you have to refill for how many times in 1 year? 6 times. And at what frequency of days you have to fill? For every 60 days you have to fill your stock. In stock turnover ratio, if the ratio is higher, it is more positive, because if you are replacing number of times means you are making fast moving sales. Next, coming to the second one, debtors turnover ratio. Debtors turnover ratio means here you will see the relation between debtors and sales. In short form, what you will say, DTR. So DTR is equal to net credit sales by average debtors or closing debtors. Here net credit sales means what? You will make sales, right? Sales includes what? Cash sales plus credit sales, right? But when you are calculating DTR, you have to take only credit sales. We should not take cash sales. Here it is mentioned net credit sales. Net credit sales means what? Out of gross credit sales, you deduct sales returns also, right? So whatever the amount you will get, that you will take as net credit sales. Say for example, your credit sales amount is 1 lakh, right? And sales returns amount is 10,000. So how much you have to take? You have to take only 90,000. Means how much of amount we have sold on credit basis. After deducting sales returns, we will take that amount here, divided by average debtors or closing debtors. See, average debtors means how you will get opening debtors plus closing debtors divided by 2. This information is not available. Means if you are not having opening debtors information with you, then what you can take instead of average debtors, you just take closing debtors. Means whatever the amount that is given in your trial balance, you can take directly here in this formula. So what's the formula? Net credit sales by average debtors or closing debtors. So when you calculate this, you will get number of times you can collect debts from your customers, means debtors. Using the DTR, next what you will calculate? You will calculate debt collection period. What is the meaning of debt collection period? Means how many times in a year you can collect debts from your debtors. So how you will calculate that? By using this formula. So here debt collection period, right? So number of effective days in a year, in 1 year, right? Divided by our DTR. So if you take number of, generally in books they will give 360 days. So that is why we'll write 360 days divided by, say if the DTR is 6 times. 60 days divided by 6 times means you will get how many days? 60 days. So for every 60 days, you will go and collect your debts from your debtors. The same way, we will do creditors turnover ratio also. Creditors turnover ratio means net credit purchases divided by average creditors or closing creditors. Same like debtors turnover ratio, we'll calculate creditors turnover ratio also. So instead of sales, we just use purchases. So net credit purchases means what? When we have cash purchases and credit purchases also, we will not take cash purchases into account, but we will take only credit purchases. Okay, and from this amount you have to deduct if any purchase returns are there, right? So then what you will get? You will get net credit purchases. Clear? So now we have to divide that with average creditors or closing creditors. So how you will get average creditors? Opening creditors plus closing creditors divided by 2. In case if opening creditors amount is not available, then what you can do? You can just take creditors only. What creditors? Closing creditors. What is the meaning of closing creditors? Whatever the amount that is available in our trial balance, what we take under a balance sheet, that amount we have to take on in the denominator. When you divide this using this formula, what you will get? You will get CTR. Okay, again we have to use this CTR formula. We will calculate our debt payment period. How you will calculate debt payment period? Debt payment period is equal to, what's the formula? Number of effective days in a year, right? In 1 year, right? So divided by our CTR, what we have calculated here, right? So 360 divided by, suppose you got CTR 4. So 360 divided by 4 means how much? 90 days. Means for every 90th day we have to pay our debts. So this is about creditors turnover ratio and debt payment period. So remember, in debtors turnover ratio, we should also include bills receivable. In the same way, in creditors turnover ratio, we should include bills payable amount also. What is the ideal ratio for DTR? It is 10 to 12 times is the ideal ratio. For CTR, it is more than 12 times is the ideal ratio for CTR. What is our fourth one? Working capital turnover ratio. So what is working capital? Working capital means the amount what we require to run our business operations. So we see two types of capital. One is fixed capital and the other one is working capital. So working capital we use to pay our recurring expenditures, means regular expenditures. So what's the formula for working capital turnover ratio? COGS means cost of goods sold. Suppose if COGS is not given, then we can take sales also, divided by working capital. What is the formula for working capital? Current assets minus current liabilities. Means how much of, what is the value of our current assets, from that you deduct current liabilities, then what you will get? You will get working capital. So the formula is what? Cost of goods sold by working capital. Suppose if cost of goods sold is not given, then sales by working capital. Next, fixed assets turnover ratio. So here you will take net sales. What is the meaning of net sales? Sales minus sales returns. So whatever the amount that will remain, that we will take as net sales, divided by net fixed assets. Net fixed assets means what? Deduct depreciation from our fixed assets. So whatever the amount that will remain, that is called what? Net fixed assets. Means fixed assets minus depreciation. If the FATR is higher, means we are effectively using our fixed assets. Total assets turnover ratio. Net sales by total assets. So net sales means sales minus sales returns. Then what are total assets? Total assets means net fixed assets, means fixed assets minus depreciation plus current assets plus investments. Here we will not take fictitious assets. So when you take these three amounts only into account, what you will get? You will get total assets. So what's the formula? Net sales by total assets. Then you will get total assets turnover ratio. If the total assets turnover ratio is high, means we are effectively using our assets in our business. It shows the ability of the firm to use, means to utilize the investments in the business effectively. So this is about turnover ratios. Now I will show you one problem. We'll solve that problem and we'll see how these ratios are used in that particular problem. This is our problem. Using this problem, we'll calculate all these ratios. So first we'll calculate stock turnover ratio. Stock turnover ratio is equal to cost of goods sold by average stock. Right? So how you will calculate cost of goods sold? See, for calculating cost of goods sold, we require opening stock, plus purchases minus closing stock. What is our opening stock amount? 2 lakhs. And what is our purchase amount? Total purchase is 14 lakhs minus our closing stock. Closing stock is how much? 2 lakhs 40,000. So 13 lakhs 60,000. So divided by average stock. So what is our average stock? Opening stock plus closing stock divided by 2 means it is opening stock is 2 lakhs plus closing stock 2 lakhs 40,000 divided by 2 means it is how much? 2 lakhs 20,000. Right. Now if you take this in our formula, 13 lakh 60,000 in COGS place divided by average stock, that is 2 lakhs 20,000. How much you will get? 6.18 is our stock turnover ratio. How much? 6.18. Now we'll calculate stock conversion period. So stock conversion period is equal to how many effective days in 1 year? 360 days. Take this formula. Number of effective days in a year means how many days will take? 360 days divided by STR. So what is our STR? 6.18. So here we'll take 6.18. So here you will get 58.25 means 58 days. So for every 58th day, we can fill our stock. So with this, what you can understand? We can understand that the stock is moving very quickly. Means we are replacing our stock. 6 times around we are replacing our stock. So it is called what? Fast moving of our stock. Means it's a good sign because there is no need for us to incur more storage costs. That is the interpretation of this stock turnover ratio. Next we will do debtors turnover ratio. So take screenshot. Debtors turnover ratio. So what's the formula for debtors turnover ratio? Net credit sales by average debtors or closing debtors. So do we have net credit sales here? So use this formula. So net credit sales means total sales minus cash sales. Do we have sales returns? No, we don't have. So our total sales amount is 24 lakhs. From that you deduct 6 lakhs. So 24 lakhs minus 6 lakhs. This is what? This is our net credit sales divided by average debtors. Average debtors means here our opening debtors is 1,50,000 plus closing debtors is 2,10,000. 24 lakhs minus 6 lakhs means 18 lakhs divided by 1,50,000 plus 2,10,000 divided by 2. How much you will get? 3,60,000 divided by 2 means it is how much? 1,80,000. So how many times you have to collect your debts? 10 times. So your DTR is how much? 10. Next, debts collection period. Debt collection period. What's the formula? Number of effective days in 1 year. So here we will take 360 days divided by DTR. What is our DTR? 10 times. So 360 days divided by 10 times means it is 36 days. Means for every 36 days we can collect our debts. Means number of times, how many times you are going to collect our debts? 10 times. So that means for every 36 day we can collect our debts. So this shows that the company is having effective credit policy and it can able to collect its debts very quickly, and this will definitely avoid bad debts. So this is the interpretation of what? Debtors turnover ratio. Now we'll go to third one. What's the third ratio? Creditors turnover ratio. Creditors turnover ratio. What's the formula? Net credit purchases divided by average creditors or closing creditors. So net credit purchases. Here we can also take bills payable, but here bills payable amount is not given. We are taking only net credit purchases. Now see purchases. What's the total purchase amount? 14 lakhs, right? So out of this 14 lakhs, you deduct cash purchases. What is your cash purchase amount? 3 lakhs, right? So how much you will get? 11 lakhs divided by average creditors, means opening creditors plus closing creditors divided by 2. So 1 lakh 20,000 plus 1 lakh 80,000 divided by 2. So here what you have taken? Net credit purchases, means total purchases minus cash purchase we have deducted. Then we got what? Net credit purchases divided by average creditors. Average creditors means opening creditors plus closing creditors divided by 2. So here what is that amount you will get? 11 lakhs divided by 1 lakh 20,000 plus 1 lakh 80,000 means 3 lakhs. 3 lakhs divided by 2, it is 1 lakh 50,000. It is 7.33. Means we can pay our debts 7.33 times in a year. Means it is 7.33. I am taking it as 7 times. Or it is how many times? 7 times. Creditors payment period. What is the formula? Number of effective days in a year divided by CTR. So number of effective days in a year, 360 days divided by, what is our CTR? 7.33. So how much you will get? 360 days divided by 7.33. 49. So you will get 49.11. Our debt payment period is 49.11. Means for every 50th day we can pay our debt. So what is the interpretation of this creditors turnover ratio? So here the firm is enjoying good credit period and it is taking a good time to make its payments, and also it is maintaining good relations to see that that amount is paid within the reasonable time. Means the time is not very lengthy, in the same way the time is not very short also. So it is maintaining good debt payment period. Fourth one, that is working capital turnover ratio. Working capital turnover ratio. So what is the formula? COGS oblique sales by working capital. So here what we can take? So if you take COGS, what we have already calculated, that is 13 lakhs 60,000 divided by working capital. So how you'll get working capital? It is current assets minus current liabilities. So what is our current assets value? 6 lakhs. and the current liabilities value 3 lakhs. So here we will write 6 lakhs minus 3 lakhs, right? So that means 13 lakhs 60,000 divided by 3 lakhs. So 4.53 times. With this, you can say that the firm is effectively using its working capital. So fifth one is fixed assets turnover ratio. I am writing FATR. So what's the formula? Net sales by net fixed assets. So what is our net sales amount? Because we are not having any sales returns, so we can take 24 lakhs directly. So 24 lakhs divided by net fixed assets. So here we are not having any depreciation, so we can take these fixed assets directly. Here I am taking fixed assets amount 8 lakhs. So this is for how many times? 3 times. So we are using our fixed assets very efficiently and we are making good sales. So we can say that our company is using effectively all the fixed assets like plant and machinery, buildings, etc. and generating good sales amount. We'll go to total assets turnover ratio. So how we have to show? TATR means total assets turnover ratio. What is the formula? Net sales by total assets. So our net sales amount is, our total sales is net sales because we are not having any sales returns. So I'm taking here total sales as net sales and writing here 24 lakhs divided by total assets. Means here what assets we have to take into consideration? Fixed assets and current assets. Here we are not having any fictitious assets, so no need to worry about that. So here I am taking fixed assets amount 8 lakhs plus current assets 6 lakhs. So 24 lakhs divided by 14 lakhs. So what is the ratio? We got 1.71 times. So it shows that moderate utilization of our fixed assets and current assets. That means neither underutilization of assets nor excessive idle assets. So this is about preparation of stock turnover ratio, debtors turnover ratio, creditors turnover ratio, working capital turnover ratio, fixed assets turnover ratio and total assets turnover ratio. Today we have covered all these 6 turnover ratios and we have done one problem also using all these ratios. So with this we have covered our third part of our ratio analysis ratios, that is turnover ratios. That's all for today, but learning never stops. In the next video, we'll do profitability ratios. If you like my videos, please like, share and subscribe. Please share my videos to your friends who are having these subjects. This will give me a lot of motivation if my subscribers are watching my videos. And more students are getting benefited by my videos. I'll be feeling very happy. This will be a good motivation for me to do more and more videos. I'm also making videos in cost accounting, business economics, investment management and financial accounting. Please watch those videos also. Keep learning, keep growing. Thanks for watching. We'll meet in the next video. Thank you.